I ranked the 6 financial habits that actually separate high earners and sales from everyone else on commission income. And at least 2 of them are going to make you rethink what you've been measuring your progress against. Now, if you're sitting there thinking, I already handle my money well because you're not behind on bills, that's the trap. Let's get on the same page. Not being behind isn't a financial habit, it's a minimum standard. The habits that build real wealth on variable income are completely different. They're operating behind the scenes and almost never get talked about in a sales meeting. I work with sales professionals on managing variable income, which means I spend most of my time on financial behavior, not investment strategy. And what I've watched consistently is that the gap between a high earner who accumulates wealth and one who doesn't almost never comes down to income. It typically comes down to a short list of specific habits that either run in the background compounding for you or quietly working against you while you close deals. These habits aren't things I read about. They're the ones I use in my everyday life, and number 5 enabled me to quadruple my net worth in just 3 years of roofing sales. So let's jump into the 6 habits, starting with the one most people know they should do and almost nobody actually does. Most commission earners have good intentions about what to do with a check when it hits. High earners, on the other hand, have a predetermined system that runs before the intention has a chance to get overridden by the chaos of the week. So many people have 1 or 2 bank accounts where all their money sits. They use the same account to pay their taxes, their mortgage, bills, grocery trips, and a weekend vacation. Everything is jumbled up in what I call a financial junk drawer. What I'm talking about isn't paying yourself first. It's about getting structured and organized by building a financial infrastructure using multiple bank accounts so that your money flows into the right destination. Same-day allocation means the moment a commission check lands in your account, a set percentage leaves for a named purpose before you make a single spending decision. Taxes go to a separate account at a separate bank with no debit card attached. Living expenses go to your main checking. Those go wherever you've designated, like a high-yield savings account, debt payoff, or an investment account. The fun account gets its cut too. Every dollar has a destination before you've had time to feel rich. The reason same day matters is purely behavioral, not mathematical. Money that sits in one account for 3 days starts to look available. It starts to look like breathing room, and that's how problems can develop. Now, I'm not talking about restrictions here. I'm talking about setting healthy boundaries that cover a comfortable lifestyle that doesn't hinder your future goals. If you're not moving money to named destinations the same day a check clears, you're leaving yourself open to money slipping away unnoticed. This next one almost always gets missed when making a sales forecast. The value of knowing your after-tax number is so underestimated, and it's where most commission earners get hurt the worst. If you're skipping it in your sales forecast, then everything else breaks. Your after-tax number is not typically the check amount. It's what you actually keep after federal and state taxes, self-employment tax if you're 1099, and any other obligations that come off the top before the money is genuinely yours. Whether you're W-2 or 1099, you need to know what percentage of every check belongs to the government before you plan around the rest. Every other financial decision sits downstream of it. Spending targets, savings rates, investment contributions, and debt payoff plans. All of it gets built on the net, not the gross. Even if you're a W-2 commission sales rep like I was, you still need to run a version of this in your forecast. I built my income targets backward from what I need to keep, factoring in the tax obligation at the gross level, and made sure the production goal I set produced the after-tax result I was aiming for. Most guys set a gross income goal, hit it, and then get surprised by what they actually have left. This matters more on commission income than it does for a salaried earner because the swings from month to month are much larger. A $30,000 month feels dramatically different from a $6,000 month, but the percentage going to taxes is the same either way. The sales rep who doesn't know that percentage, even an approximate value, is making spending decisions on a number that overstates his actual resources every single time. The bottom line is if you're treating the gross number as the real number, you're planning with money that was never actually yours. This next one is technical, but it causes more financial damage than most people realize, and it's easy to fix. When you want to know what you actually earn, the instinct is to add up 12 months of income and divide by 12. That gives you your average. For some reps, the average is exactly the right number to plan around. For others, it's the number that quietly sets them up to fail. Here's how to tell the difference. If you're consistently active year-round, knocking doors or running appointments every single month regardless of the season, and your lead volume is steady, your average is a reliable baseline. The months are different in size, but they're all real production months. Your average reflects your actual earning pattern. But if your income swings dramatically because of seasonality, storm cycles, or periods where your activity dropped off, one monster month with a $40,000 storm check in September can pull your 12-month average up dramatically, even if 7 of those months were between $4,000 and $10,000. Your average says you're a $14,000 a month earner. The middle of your actual income distribution might be $8,000. In that situation, the median is the more honest number. That $6,000 gap is where lifestyle commitments get made that can't be sustained. You sign the truck payment, you take on the mortgage, you set the vacation budget, all at the average. Then you live most of your months at the median, constantly short, constantly wondering why the math doesn't work, never identifying the root cause. The forecasting approach I used in roofing sales was built around the average because I had consistent lead volume and enough data to trust it as my real baseline. But the guys I've watched get hurt financially were almost always planning from an average that a handful of big months had inflated beyond what their normal production could sustain. Before you pick your planning baseline, ask yourself honestly whether your income history reflects consistent activity or whether a few outlier months are pulling the number up. Average works when the activity is consistent. Median works when it isn't. Know which one you are before you build your lifestyle around either number. High earners have a sequencing rule about money. The buffer comes first. Everything else comes after. It's the time as the financial foundation for years. Paying yourself first isn't sexy. It's not anything new or sophisticated, and that's why it stood the test of time as the foundation for all financial success. A cash buffer is 6 to 9 months of bare bones living expenses sitting in an account at a separate bank. No debit card attached, and it's earning something meaningful rather than sitting at zero. It's the structural cushion that absorbs the volatility built into commission income so your investing contributions, your debt payoff, and your monthly household doesn't get disrupted every time a slow stretch hits. The reason the buffer comes before investing is simple. A commission earner who doesn't have a cash buffer will stop investing the moment a slow month threatens the household. That disruption, repeated 2 or 3 times a year during every slow stretch, is what keeps the investment account from compounding the way it should over decades. Or worse, you raid your investment account to cover your expenses. The buffer makes the investing contributions untouchable because the household already has a cushion to absorb the occasional slow periods without ever touching anything else. This also prevents the "I'll invest when things settle down" conversation in your head that keeps most commission earners waiting indefinitely. Things don't settle down in sales. The income structure is variable by design. The buffer is what creates the stability that makes consistent investing possible regardless of what the month actually looks like. Build the buffer first. Then the investing contributions or debt payoff run without interruption because nothing in a slow month can reach them. If a slow month has ever caused you to pause, skip, or pull back on investing contributions, the buffer wasn't fully built yet. If these habits are exposing a gap you didn't know you had, be sure you hit subscribe before we get into the last 2. These are the ones most high earners know about conceptually, and almost nobody actually runs consistently. Here's the habit that helped me quadruple my net worth in just 3 years of roofing sales. Most guys track income and call it good. High earners track net worth. Those are not the same measurement and they don't produce the same behavior. Income tells you how much came in. It's important, but it sometimes becomes a vanity metric. Net worth tells you how much actually stuck. Net worth is assets minus liabilities, but in reality, it's so much more useful than that definition makes it sound. It's the number that tells you whether you're actually building something or just cycling more money through a lifestyle. For instance, a sales rep who closes $200,000 in a year and ends it with the same net worth as when he started hasn't built anything. This is what it means to get caught up in the rat race. The income happened, but the wealth didn't accumulate. Those two things can coexist for years without ever diagnosing the problem because the income number is the only thing being watched. Now, I've tracked my net worth on the last day of every month for years, and it has changed how I make every financial decision. Why monthly? Because net worth is just a snapshot at one moment. You need several recordings to start seeing performance trends. When that number isn't moving, you can easily pinpoint what's causing it. It also gives you something income alone can never give you, a real milestone to work towards. I've been working towards the millionaire milestone, and the only way to know whether I'm on track is to watch the net worth number move month over month. If you have a number you're trying to hit, whether that's your first $100,000 in assets, your first $500,000, or 7 figures, the monthly net worth check is the only scoreboard that actually measures progress towards it. Everything else is just revenue. The gap between perceived wealth and actual net worth, between what the income suggested they should have built and what the balance sheet actually shows, is where the real financial work begins. Once you see the number, you can't unsee it. And once you're tracking it monthly, every financial decision in your household runs through a different filter automatically. Take 15 minutes this week and run your net worth. Add up what you own, subtract what you owe, and write down the number. That number is the one that matters. Now, this is the hardest one on this list because it runs directly against the identity of someone who earns through performance. You had a great month, so you feel like you should be able to show for it. Living from a place of abundance rather than scarcity. And you're right, but within a structure that accounts for it. The problem is so many commission earners inflate their baseline lifestyle more than they really can justify, rather than increasing their wealth building rate when the income spikes. I get it because I've been there. I know what it feels like to cross income thresholds that used to seem out of reach. I went from barely scraping by to crossing 100 grand for the first time. Eventually, I was closing over 200 grand in a year. Each of those thresholds came with a real pull to let the lifestyle reflect the number. What made the difference wasn't willpower. It was having a system that directed the upside before I had a chance to spend it. The wealth got built in the gap between what those months produced and what I let myself spend. That margin, the space between what you earn and what you spend, is the only raw material wealth is ever made from. Widen the margin and you build faster. Let lifestyle close the gap and the income keeps flowing while the net worth stays flat. What I watched in roofing sales was the same pattern every time. Strong storm season, a few monster months, and the lifestyle follows the income up immediately. New truck, upgraded house, boat, vacation, and the loose spending that felt justified at the time. Then the next season underperforms, or retail slows down, or a dry stretch hits, and the fixed costs from the lifestyle expansion are still there. I kept my lifestyle deliberately flat during my years in sales because I had a specific goal I was pointed at, and I knew that every dollar that didn't go towards that goal was a dollar that extended the timeline. The $175,000 mortgage paid off in 16 months on commission income only worked because the lifestyle didn't expand when the big months hit. The reason I tell you that isn't to impress you with the number. It's because the system only worked because there was a goal behind it. A goal that was specific enough to say no to things that would have felt completely justified in the moment. Without something to point the money towards, lifestyle fills the space every time. It always does. The sales reps I've watched build real wealth weren't the ones who earned the most. They were the ones who had a number they were working towards and a structure that kept every commission check moving in that direction. The last time your income spiked, ask yourself honestly what changed in your lifestyle and what changed in your net worth. If the lifestyle moved and the net worth didn't, you close the margin. Pick a goal, build the structure around it, and protect the gap. I hope this video helped you. Let me know your thoughts in the comments below of which habit has made the biggest impact for you or that you want to focus on building. If this list exposed something you want to fix, hit subscribe because every week I break down money management specifically for sales income. Before you can manage money, you've got to get crystal clear on projecting your income with confidence. Be sure to grab the free Feast Your Famine Survival Guide. It's the first step in my variable cash management system called Feast and shows you several examples on how to hit 6 figures in roofing sales. I'll leave the link to the guide as well as the full system for you to check out in the description. In the meantime, thanks for watching, and remember, you're just one roof away.